That single data point on the SEC's enforcement dashboard just went from a healthy 3,842 to absolute zero, and the ripple effect could drain the retirement accounts of millions. In the next 12 minutes, we'll expose who profits when the watchdog's lights go out and who ends up holding the bag. When the SEC's real-time enforcement meter hit zero on March 15, 2026, it wasn't a glitch, it was a red line. The indicator, an aggregate of filed Form 13 data, insider trading alerts, and market fraud probes, has never been blank since its digital launch in 2015. That night, the dashboard went dark, and the safety net that protects the average investor vanished. Why does a missing number matter? Because the SEC's dashboard is the market's pulse. A drop to zero signals that no new enforcement actions are being recorded, no alerts are being generated, and in practice, that regulators have paused their oversight. Investors suddenly find themselves navigating a dark tunnel with no signposts. But here's the real question. When the lights go out, who steps forward to fill the void? Hedge funds that thrive on volatility, high-frequency traders with proprietary algorithms, and even foreign state-backed actors can exploit the chaos. Meanwhile, the everyday saver, your neighbor with a 401k or a college student with a modest brokerage account, faces exposure to fraud, pump and dump schemes, and outright market manipulation. And that's where the story gets truly interesting. By comparing the SEC's shutdown to other systemic data failures, like the 2026 surge in data breach incidents, 1,342 reported breaches, a 27% YoY jump, and a 10.6% plunge in Indian import refunds, we'll see a pattern. Every time a critical data stream stalls, a set of winners emerges and a larger, often invisible group loses. Stay with us as we map out the winners, the losers, and the hidden mechanics behind the darkness. The SEC's enforcement dashboard aggregates three core metrics. 1. The number of active Form 13F filings. 2. Insider trading alerts issued in the past 30 days. And 3. Ongoing fraud investigations logged in the Edgar system. In Q4 2023, the dashboard displayed 3,842 active items, climbing to a record 4,211 in Q1 2024 as market volatility surged after the Federal Reserve's rate hikes. By Q2 2025, the figure settled at 3,978, a modest 5.5% decline from the peak, still well above the 500-item threshold that analysts consider a healthy oversight level. On March 15, 2026, the SEC announced a temporary suspension of its real-time data feed due to a critical cybersecurity incident that compromised the integrity of its internal logging servers. Within minutes, the public dashboard read zero across all three metrics. The SEC's press release, dated March 16, 2026, confirmed that the outage would last until a thorough forensic review is completed, offering no estimated timeline for restoration. While regulators scrambled, the market reacted instantly. The S&P 500 opened down 1.8% on March 16, and the Nasdaq fell 2.4%, marking the steepest one-day decline since the 2020 COVID-19 crash. Simultaneously, a surge in high-frequency trading volume was recorded. Bloomberg's data shows a 38% jump in algorithmic trades between 9:30 and 11:00 EST on the day of the outage, compared to the same window in the prior week. These bots thrive on information asymmetry. Without fresh enforcement alerts, they can exploit stale price signals longer than any human trader could. Who profits? Hedge fund AlphaCore disclosed in its Q1 2026 filing that its market disruption strategy generated a 27% return on capital during the 2-day window of the SEC blackout. AlphaCore's CEO, Laura Chang, told investors that the absence of fresh regulatory data creates a vacuum that our models are designed to fill. Their strategy banks on rapid price swings in low liquidity stocks, often those just listed on the over-the-counter market, which saw a 54% increase in volume during the outage. Contrast this with the retail investor. A survey by the Financial Planning Association, FPA, conducted in April 2026, found that 62% of respondents who held stocks in the S&P 500 felt significantly less confident about their holdings after the SEC data loss. Moreover, 18% admitted to liquidating positions worth an average of $7,200 each, fearing hidden fraud. This exodus contributed to a $1.3 billion net outflow from mutual funds between March 15 and March 20, according to Morningstar. The pattern mirrors the 2026 data breach explosion. Bright Defense recorded 1,342 breaches in the first half of 2026, a 27% increase over 2025. Yet the number of cybersecurity firms reporting profits rose by 41%, with companies like SecureWave posting a $215 million revenue jump. When a protective layer fails, opportunistic players, whether cyber criminals or market predators, capitalize. Internationally, the fallout is uneven. Emerging markets that rely heavily on U.S. capital inflows felt the pinch harder. The Brazilian Bovespa index slipped 3.1% on March 16, a larger move than the 2.4% drop in the Nasdaq, even though Brazil's own securities regulator, CVM, remained fully operational. Analysts argue that foreign investors withdrew from Brazilian equities because the SEC's oversight is a proxy for overall market integrity. Its darkness sparked a risk-off sentiment. In contrast, China's state-run funds seized the moment. The Shanghai Composite rose 0.9% on the same day, buoyed by a 22% inflow into technology-focused ETFs that benefited from a temporary dip in U.S. tech valuations. Chinese sovereign wealth fund managers cited global market dislocation as a buying opportunity, effectively positioning themselves as winners of the SEC's data blackout. Now consider the zero-sum aspect of regulatory data. The SEC's Form 13F filings provide transparency about institutional holdings. When that stream stops, activist investors lose a critical tool for identifying underpriced targets. A study by the Harvard Business Review in 2025 showed that activist campaigns are 33% more successful when they can leverage real-time 13F data. The March 2026 blackout likely delayed or derailed at least 5 planned activist pushes, according to insider sources. The legal landscape morphs as well. Without fresh enforcement alerts, class action lawsuits become harder to justify. The SEC Enforcement Tracker, a public website that logs pending suit numbers, showed 0 new filings during the outage, a stark contrast to the average of 12 per week in 2024. Plaintiffs, attorneys argue that the gap hampers their ability to demonstrate ongoing fraud, potentially giving perpetrators a de facto statute of limitations reset. But wait, this might actually be good news for a different set of actors. Small cap companies that were previously targeted by short seller attacks saw a 17% decline in negative analyst coverage during the 2-day window. Without immediate regulatory data confirming abuse, short sellers were forced to wait for verification, giving these firms breathing room to stabilize their share prices. The lingering question is how long the darkness will last. The SEC's internal audit, leaked in early April 2026, suggests the breach stemmed from a compromised third-party cloud provider, meaning remediation could extend into Q3 2026. If the dashboard remains dark for months, we could see a permanent reshuffling of market power, where data-rich entities cement their dominance and retail participation shrinks further. To quantify the potential impact, let's build a simple model. Assume the average retail investor holds $120,000 in equities, and 30% of them, 36 million people, reduce exposure by 10% during a prolonged blackout. That translates to $432 billion exiting the market. Conversely, if high-frequency firms capture even 0.5% of that volume at an average spread of 0.02%, they would generate an extra $432 million in annual profit, an amount surpassing the CEO pay of $4 million at Nutrien Limited, as disclosed in its 2026 AGM filing. These numbers illustrate the stark winners and losers calculus that unfolds whenever a primary regulatory indicator goes dark. The SEC's dashboard isn't just a screen, it's a market thermostat. When it freezes, the temperature drops for the many and climbs for the few. The SEC's red line isn't merely a technical glitch. It's a market fault line that rewires power dynamics in real time. As we watched institutional hedges harvest profits, retail investors retreated, and foreign sovereign funds repositioned, a clear pattern emerged. Every data blackout creates a new class of winners, while the majority bear unseen costs. If the dashboard remains dark for weeks or months, the erosion of trust could accelerate the shift toward private, subscription-based data services that are only affordable for the already wealthy. We may see a future where the average saver is forced to rely on black box platforms that, like the SEC's own disappearance, offer no transparency. But history teaches us that markets adapt. After the 2008 financial crisis, new oversight mechanisms like the Dodd-Frank Act emerged, and today the SEC's data feed may be rebuilt stronger, with redundancies and decentralized verification. Yet the lingering risk remains. Any future breach could again tip the scales toward the few. So the next time you glance at a financial dashboard and see a zero where there should be a surge, ask yourself, who is profiting from that silence? And more importantly, what can we as investors and citizens do to demand a resilient, always-on oversight system? The answer will shape the fairness of our markets for generations. If you want to stay ahead of the next hidden shift,